So I guess one good thing that has come out of the last 4 months for me personally is I've learned a lot about financial markets and how these things kind of work. And I've learned about the relationships between, like government policy and the stock market and the bond market, U.S. Treasuries, and how things have worked in the past versus how these things are interrelating with one another right now. And, yesterday, so it's Friday, May 23rd. Republicans passed their big, beautiful budget yesterday. The markets are revolting. Stocks are going down today. And the one thing that I didn't understand before is why interest rates in the bond market a couple months ago started going up and what that means. I always thought like higher interest rates, if you're investing in something and you get a higher interest rate, that's a good thing. I did, what do I know? But then I learned that, I knew that U.S. Treasury bills represent like our national debt, U.S. debt that is backed by the full faith and credit of the United States and the United States government. And that those have typically almost always been viewed as a rock solid, incredibly safe investment. And then we decided collectively as a nation that we should re-elect Donald Trump for a second term. So much for that full faith and credit of the United States. Donald Trump hasn't said it outright, but he's kind of hinted, and it's certainly consistent with his business practice history, because when he was a real estate developer and all that stuff, he used a lot of debt, and then he would default. He would default on that debt, which would give him the opportunity to renegotiate that debt at terms that were more favorable to him personally. You can't do that with our national debt. You can't do that with the full faith and credit of the United States of America. It certainly looks like we're heading that way. And typically in the past, if there has been what people in the before times would refer to as a market correction, meaning the stock markets are crashing, there's a huge sell-off, meaning that investors are selling their stocks and then they have these huge chunks of cash. They previously would typically park that money in U.S. Treasury bills because they're so safe and so stable. Not anymore. In the stock market crashes day after day after day that we saw after April 2nd, Donald Trump's Liberation Day, the day that he announced his tariffs, is the markets were crashing. There was a huge sell-off, but nobody was buying U.S. bonds. Nobody was buying U.S. Treasury bills. I didn't understand why that was. And I listened to a lot of financial people, and they're like, well, because that investment no longer appears safe to international investors because they're half expecting Donald Trump to default on those bonds, on U.S. Treasuries, on our national debt. And so in order to sell those, the rate has to go up. The rate of return has to go up. That makes sense. The problem, and this year, the 10-year Treasury bond, or this week, the 10-year note, the 20-year note, the 30-year note, the 20 and the 30 are both up over 5%. The 10-year bond rate is up at like 4.8%. The problem is that as those rates go up, it affects all of the interest rates that we as Americans pay. And it drives up mortgage rates that are already up over 7%. And so now we're starting to see some reaction to this. California Congressman Ted Lieu said Trump and Republicans are directly responsible for the spike in the 30-year Treasury bond yield, which will lead to higher mortgage rates. The average I was a little off. The average cost of a 30-year fixed rate mortgage hit almost 7% this week, 6.8%. I'm not going to read a quote from Nancy Pelosi. Jesus Christ, she needs to go away. But Fortune magazine reports that investors are gradually reassessing their financial risks under the current administration. That means that they no longer view American debt, American bonds, as safe. They report that Swiss bank UBS anticipates that international investors will reverse 60% of their 5-point percentage increase in ownership of U.S. equities since 2018. So they're expecting a huge sell-off of Treasury bills, which will drive those rates even higher, which will drive mortgage rates, car loan rates even higher, higher interest rates that we are going to have to pay. Yeah. And they're doing that while taking health care away from 14 million people and passing a tax bill that's going to add $4 trillion to the national debt, a tax bill that has no middle class benefit and essentially is going to benefit about 70 billionaires in the United States. Swiss bank UBS continues. We think there has been a fundamental shift in how institutional investors view their U.S. exposure, Treasury bills. They're not attractive anymore because of Donald Trump and House Republicans. It is taking away health care for nearly 14 million Americans. It is the biggest cut to food programs we've ever seen, said House Minority Whip Catherine Clark. What we have is a bill that is almost like it's constructed by cartoon villains. That's how medieval and cruel this bill is. Donald Trump campaigned on no cuts to Social Security, Medicaid, and Medicare. This bill contains almost $1.5 trillion in cuts to Medicaid and Medicare. Donald Trump campaigned on doing exactly the opposite, and the dipshits who voted for him believed him. And now all of their mortgage rates are going to go up, and their car interest loan rates are going to go up, and grocery prices are not coming down. We're heading into a period of austerity and recession when Donald Trump said he was going to fix inflation and food prices and gas prices on day one. We're about 110 days in, and we're talking about austerity and pain and recession. All because the dipshits who voted for him believed him. Amazing.